Joining me now with more is Gregory Daco. He's the chief economist at EY. Gregory, always good to see you, especially on a week like this one where we have a lot to digest. Still not getting as much economic data as normal with the government shutdown. But what is on your radar when it comes to the state of the economy leading into this Fed decision?
Well, I think there's certainly a lot of uncertainty made worse by the fact that we're not getting any economic data on a regular basis. We did get, however, the latest CPI report for the month of September. This was mandated because the Social Security Administration has to proceed with a cost of living adjustment for the third quarter looking into 2026. And this showed us that there are gradual and uneven pressures from tariffs filtering through onto consumers. It's not a massive increase in prices, but it is this uneven and gradual process that's taking place. And at the same time, we're seeing still disinflationary pressures on the shelter cost front, on the housing cost front. So there are dueling pressures when it comes to inflation dynamics. But it suffices to say that people at the lower to median end of the income spectrum are increasingly pressured by higher prices for apparel, for groceries, for furniture. And people at the higher end of the income spectrum are still spending relatively freely. They're still supported by strong income growth and by the wealth effect that is coming out of strong stock market gains.
How do you think the Fed should proceed on Wednesday when it delivers its next rate decision?
It's very hard for Fed policymakers because, as you well know, Fed policymakers have been extremely data dependent. And in the absence of official statistics, they have to rely on an alternative set of data. Those come from the private sector, from confidence gauges like the consumer sentiment, the consumer confidence report, as well as from business confidence gauges. And when we look at confidence, there's still a lot of hesitancy on the part of consumers. Consumers are still worried about job prospects, about income prospects. They're increasingly concerned about the fact that prices are once again rising. And on the business side, there is also this gradual pass-through of tariffs that is leading to higher cost pressures at the same time as we have immigration restraints limiting labor supply and creating some bottlenecks in terms of labor availability. So we have a private sector that is under constraints and struggling really to make much forward momentum outside of certain areas. And certainly the AI CapEx boom is the key element that's driving business investment right now. But if you look at the first half of this year, outside of AI-related investment has essentially been stagnating. So for Fed policymakers, this is a very difficult economy to manage. It's a bifurcated economy where higher end consumers are spending freely, lower end of the income spectrum consumers are exercising more caution. And on the business front, anything related to AI is doing well. Anything not related to AI is actually hesitant. And the private sector employment data is showing constraints in terms of labor market momentum. So I think the Fed will likely ease 25 basis points in October, perhaps also ease 25 basis points in December. But in 2026, it's going to be a very different picture for Fed policymakers.
Before we get to 2026, Gregory, I do want to hone in on what you were saying there about AI and how companies are making that CapEx, capital expenditure investment. At the same time this morning, as it relates to jobs, we see Amazon laying off 14,000 workers as it does invest more in AI, and Chegg slashing 45% of its workforce, blaming the new realities of AI. And, quote, what does that mean on the jobs front?
I think there are two elements that we have to keep in mind. There are a number of supply shocks that are affecting economic activity. These supply shocks come in the form of trade disruptions and tariffs. They come in the form of immigration restrictions and labor supply constraints, but they also come on the positive side via the technological revolution that we're seeing from AI. And all of those supply shocks are offsetting each other to some degree, but generally speaking, businesses seem like they need less labor in this environment. And so we're seeing businesses being very strategic with their hiring decisions, hiring at a very slow pace. The hiring rate is at a 13-year low right now. We're not seeing massive waves of layoffs, but we are seeing, as you just mentioned, some firms deciding to lay off strategically in the face of this technological revolution where there might be some labor substitution. And we are in this environment where there is hesitancy as to the outlook for 2026 and 2027 in terms of final demand growth. So businesses are being very cautious with employment. And as a result, we're seeing payroll growth come down to levels around 25 to 50,000 jobs per month, which is historically quite low. We haven't seen the type of upward pressure on the unemployment rate yet because labor supply has come down significantly as a result of lower inflation. But we are in this new normal where supply side dynamics are playing a greater role, influencing business decisions, influencing consumer decisions, and where the pace of underlying growth is increasingly slowing from 3% in 2023 and 2024 closer to 2, maybe 1.5% as of today.
Yeah. Finally, Greg, I do want to ask you about trade because President Donald Trump is in Asia. We are expecting a high-stakes trade meeting between President Trump and, of course, China's President Xi Jinping on Thursday. What needs to come out of that for there to be a material impact on the economy?
I think what would be very beneficial to the economy is more clarity and stability as to trade policy. We've been for the past 8-9 months in an environment where there has been a tremendous degree of uncertainty with tariffs that are being announced on almost a weekly basis, where some exemptions are being announced also on a weekly basis. And so we have a lot of uncertainty and difficulties for businesses, both on the goods front as well as on the services front. Services, we tend to forget, are heavily reliant on goods and equipment to provide those services. So we have this uncertainty that's latent, and that's making it difficult for business leaders to make optimal decisions as to how to grow, how to invest, how to hire. If we have more clarity as to the trade situation between the US and China, between the US and Japan, between the US and Korea, that would be extremely beneficial in terms of supporting stronger economic activity as we move into 2026.
Gregory Daco, Chief Economist at EY. Gregory, always good to get your take. Thanks again.
Always a pleasure.